McDonald's is down nearly 15% year to date, as we can see trading right there towards its 52-week low, and we have a double buy rating. So is this now incredibly undervalued, and should we be making this a serious consideration for the portfolio? Today we're also going to analyze this company, but also look at some of the bearish signals, specifically like drugs like Ozempic, how it's going to affect their top line sales, and more specifically for the fast food industry where McDonald's is in, and understand what the repercussions could be for this company over the longer term. We're also going to take a look at the boycott, understand the effects it has had on the numbers, whether or not this will continue over the next few quarters, and more specifically we want to see how poor those numbers were in their more recent earnings to understand where McDonald's do go from here, and also importantly understand this $5 menu that they are bringing out. Is this something that can save their top line moving forwards? Now, as usual, we will do the normal analysis. We're going to take a look at essentially the dividend safety. We're going to run through some of the underlying metrics like the free cash flows, but we're also going to do this new element of our research. We want to see, does it outperform the S&P 500 over the longer term, or maybe is it worth just dollar cost averaging in to an ETF like Vogue? We're also going to compare to see if it is even the best in its own sector, and look at companies in a relevant size as well to see whether or not it has been outperforming over the longer term. And as always, we do want to deep dive into the numbers, their top line revenue growth, as well as their bottom line net income. And we also want to understand what is the health of this company in terms of total cash versus total debt. Is there any worries over the longer term about taking on too much debt and not being able to afford that dividend increase that we have come to love with this company over the longer term? And as always, we are going to run them into the valuation model, get to our intrinsic value, get to our acceptable buy price given our investor margin of safety, and understand whether or not Wall Street are expecting nice upside over the next 12 months. Now, before we get into any of the detail, let's just remind ourselves of how McDonald's has performed over the longer term. As we can see, year to date, down nearly 15%. Over the last 12 months, still down double digits, and if you've been a long-term shareholder, you would be up around 155%. Do bear in mind, with dividends reinvested, you would be up slightly higher, and we can see all-time highs just over $300, and we're not talking about even too long ago of a period. Now, in terms of the yield, forward-looking 2.63%, we are about to discover that actually this is on the higher end of the 5-year average, and in terms of a forward PE, just under 21, which makes it lower than the S&P 500, which does currently sit around the 22 mark. In terms of buy ratings, well, a buy from Seeking Alpha, a buy from Wall Street, and we do, however, have one hold from Quant, and we will consider this when we do look at the valuation later on. Now, in terms of the information, there are drugs that are coming out very popular for weight loss, like Ozempic as well, which are affecting the food industry, as we are about to find out. However, the question will remain whether or not over the longer term this will affect the fast food industry and the way that consumers do eat products, whether they do focus on more healthy products or they continue to eat the fast foods that they have come to love over the longer term. So as we can see, typically fast foods now will need to rethink their strategy around how they move forwards. One of the reasons for this, as we can see, is that a lot of consumers who are taking these drugs, as we can see, in fact, a third of them, they are reducing their fat intake, 38%, as well as 45% who are consuming less sugar than before. And what this essentially means, that companies will need to move away from the historical greasy fast food type of foods, like the burgers, like the chips, and pivot towards healthier offerings that can satisfy those consumers who would have typically come to buy, whether it's a Big Mac and chips or other products, and maybe something a little bit more healthier. Whether or not over the longer term, though, this will affect companies like McDonald's, we should be able to see the effects over the next few quarters, as well as in the latest annual report for 2024, as well as next year's, which we will come to analyze on this channel. What is very interesting to note, that isn't just the drugs that have been affecting their top line, but we can also see, and we'll look at the numbers, but they did post in their latest earnings weaker than expected results. One of the reasons for this, as we can see, the boycott across the Middle East, and what we're about to find out, ultimately this did lead to them missing on their numbers. So we can see from their latest article that they did miss their quarterly earnings estimates, as well as same stores falling short of their expectations. And as we can see, the boycott over the conflict in Gaza did weigh heavily, with the majority of this being in those chains in the Middle East. Now, when we take a look at the numbers, one of the things that we do also have to point out, the way that McDonald's have tried to alleviate some of this is by increasing prices. However, this is becoming an issue. Those who typically do go and spend their money at McDonald's are seeing that the higher prices are turning them away and moving towards making food at home, which is cheaper, or other joints which are a lot cheaper as well. So how they performed? Well, 270 was what their EPS, 272 was what the market expected, so they missed on the EPS, and they did have a marginal beat on the revenue, 6.17 billion versus the 6.16 that the markets were expecting. So do understand that they did miss on the EPS. That is quite big. We are going to have a look to see consecutively how good their past track record is, whether or not they have historically beaten. But as we can see, a miss on the EPS and a marginal beat on the revenue. Now, one thing that McDonald's have said they are going to be doing to alleviate some of the press that a lot of these consumers are having on the price increases, bringing out a $5 menu very soon. Now, when we do take a look at this, it may be good news. However, one thing that is very interesting to note is that this is just an offer for a very short period. In fact, it's running from the 25th of June, but it will only last for around 1 month. So this isn't anything for the longer term to substantiate or get rid of any of those issues about the high prices. And as we can see, for those that are interested in understanding what it is, 4 items for $5. As we can see, a McChicken or a McDouble, 4-piece chicken nuggets, fries, and a drink. So yes, it may be a good offer, but given it is just for 1 month, this isn't going to alleviate any of those stresses that we had talked about. And what they're ultimately trying to do is lure the customers back into their stores. And while they talk about it being an inflation-driven issue, as we did see, there is the also bearish news of Ozempic, as well as that boycott from the Middle East. So lots to consider here. We thought we would add some of this before we do run into the numbers. So let's get into the more numberable part of this episode. And what we can see, total revenues, 27.4 billion in December 2014, typically 3 to 7% increase year on year as a baseline. And what we note, 27.4 billion in 2014, latest annual report, in fact, a decrease of 25.5 billion. And as we can see graphically, that it hasn't been an increase over the longer term. In fact, a lot of inconsistency. What you will be able to note, 2014 down to 2020, they have been decreasing that top line for it to only get picked back up to around 2023. So we can see, in fact, when we look at the numbers, it did dip down to around 19.2 billion. So do bear in mind, this isn't a company that is increasing their top line consistently, and there are a lot of bearish headwinds that are coming in, not just right now in the more recent quarters, but also into the future. One thing that they have been able to do is, whilst their top line has been decreasing very marginally, they have been able to increase their bottom line, 4.8 billion in 2014, 8.5 billion in 2023. But again, we can see some small inconsistencies, but over the longer term, they have been able to increase that net income. One way that we can see that this being possible into the future as well, if they are unable to increase that top line revenue, is by increasing those margins. Lots of different ways that the company can increase those margins as well. Right now, though, they do seem to be doing it over the longer period, something that we will keep an eye on as well. We then take a look at this company's balance sheet, a quick health check. 2 billion in 2014, what we notice a very large drop down to 838 million in their latest quarterly report, especially if you look at the annual report from December 2023. So their cash has dropped quite significantly in my opinion, and as we can see though, over the yearly period, that there is a lot of inconsistency year on year, a lot of movement as well. Now ultimately, this number doesn't really mean anything in isolation, but what we always like to do, compare it to their total debt numerically and directionally, and what we can find out, it has been increasing quite significantly. A little bit of a worry for me, around 15 billion in 2014, 51 billion in that latest quarterly report. So when we take a look at it, whilst their cash is inconsistent, their total debt has been pretty much consistently increasing over the longer period, something that is ultimately very important when we do come and take a look at that dividend safety, because if their debt continues to rise, that will put a lot of pressure on them being able to pay out a nice dividend increase. And as we can see, 9.9% increase in the more recent period. So let's take a look now at what I would like to see in terms of a track record as well as forward looking. Over the last 4 quarters, they have beat analyst targets 3 of the last 4 periods, so that's a 75% track record. But what we do note in the more recent quarter, they did miss, although marginally, as we can see here. In terms of moving forward, well, the next quarter they do anticipate low single-digit decrease year on year, and then the next 3 periods consecutively around mid-single-digit increases. So just be realistic with your own estimations in your own analysis as well. This isn't a company with strong double-digit increases. In fact, the next quarter they are anticipating a decrease year on year. And if you want to be forward-looking to December 2025, we do note that the forward P, based on the earnings per share estimate, will sit around 19.13. Now, what we like to do here is just run through some different underlying metrics and some gradings. First one is the valuation. They get a D-. Now, what I like to do is just point out that a P non-gap forward of around 21, the sector median as a whole 15.97. Now, as we typically mention, it could be warranted and justified for the higher than sector median, essentially PE, but that is something we will cover as part of our analysis. So it is trading at around a premium of 30%. Other metrics as well, you can see the ratings. It is pretty poor, so do bear that in mind. Obviously, different people will prefer to look at different metrics, so you can see that on the screen. We then move on to the growth grade. Now they get a C-, so let's just digest that information. 10% increase to their revenue year on year. Nice to note, a lot better than the sector median, low single digit. Forward looking, just under 7%. Again, better than the sector median of 3.6. One of the things, though, that I'm severely disappointed in is the expectation of the earnings per share. Over the next 5 years, they're estimating 6.3%, whereas when we look at others, around double-digit 11.34%, so they are worse off by around 45%. So do factor that in. That does seem to be pretty much the only one where they are underperforming, or the expectation is to underperform others in the sector. But as we can see, that is a very important one, and that does form part of our analysis in the valuation aspect later on. Now, in terms of the profitability grade, just before we do get into this, we do also want to let you know that we have released our latest free weekly article where we do run through 12 undervalued dividend high quality stocks. If you want access to this or any others, all completely free, do click on that pinned comment below. You get instant access. For example, if you want to see the websites and resources we use, do click on this article. And we do talk about a lot of other useful information, all completely free, just by clicking on that pinned comment below. We then move on to the profitability. Now, they do get an A+. As we can see, very nice to note, their gross profit margin a lot better than the sector, 57 versus 37. Bottom line, significantly better, 33.36 versus the sector median of 4.8. One of the reasons why they can continue for that top line to decrease or marginally increase, yet their bottom line to increase, given that bottom line margin as well as their gross profit margin are high, and a lot higher, in fact, than the sector median. We also note their cash from operations just under 10 billion, with others around 284 million. So just as a quick reminder then, we got a double buy rating, seeking alpha with Wall Street with a hold from quant, D- on valuation, C- on growth, with an A+ on profitability. Now, one thing that we always like to do is very quickly compare them to others in the industry. We have a lot of popular names: Starbucks, Chipotle Mexican Grill, DoorDash. What we can see over the last year, now factor in that this is total return, so includes reinvesting those dividends, McDonald's is down 10%, one of the worst performing, as we can see, with the others in the industry. When we expand it to the last 5 years, in fact, they are second best, up 42%, with the best being CMG. And when we expand it over the longer period, we do see again second best, 228%. Now, do bear in mind that over the period, it has been a bit of a roller coaster. Some years very good, some years very poor. But if you are a longer term shareholder in this company, it has been a pretty decent 227.54% return. As always, though, do please bear in mind that past performance is not an indicator of the future performance. Now, one thing that we like to add to our analysis, a quick look comparison versus the S&P 500. Year to date, McDonald's down 13%, S&P up 12%. When we expand it to the last 12 months, again, a very similar story to be said. Over the last 5 years, we do see S&P again outperforming 86% versus McDonald's 42%. But when we do expand it over the last 10 years, in fact, McDonald's has performed a lot better, 231%, S&P 500 176%, although a lot of people may argue that for the security of an ETF like VO, it may be better than buying an individual stock like McDonald's, especially looking at the more recent track record. As always, though, do let me know your thoughts about this in the comments below. So now let's jump into the dividend safety. We have a score of 77. It does look to be safe. Market cap 183 billion. It is a mega cap company. We can see it was just reaffirmed a few weeks ago. Dividend cut does look to be unlikely. Now, in terms of the last recession, a lot of good news here. They increased the dividend during the Great Recession of 07-09, negative 6% recession sales, so above the average of the S&P's negative 12, and one of the best recession returns, just a negative 3% drop. S&P as a whole did drop negative 55%. So you could argue that this is essentially a recession-proof stock based on historical performance. Dividend growth pretty decent as well. 9.9% increase in October, 8% over the last 5 years. Double digit over the last 20 years, very strong. And what we can see is they're only 3 years away from becoming a dividend king. They have increased those dividends for the last 47 years. Now, what we also like to point out, as always, dividend yield theory does state the company is undervalued when the current yield sits above the 5-year average. So we have our first signal of undervaluation. Another signal, given 20.6 forward P is lower than the 5-year rolling of 25.4. But please bear in mind, we're not looking at any of these models in isolation. We will conclude towards the end. And we can see the consumer discretionary sector P is much lower, as we did talk about it earlier. So again, lots to consider, a lot of information that we are running through in these deeper dives. As always though, free cash flow payout over the earnings, which is susceptible to manipulation by management through accounting. Below 50% for restaurants if you do want to be industry specific. My blanket rule, 60% or lower. That does give me faith, and management are able to offer those double-digit increases we love to see. Now, the trend for McDonald's has been decreasing over the longer term. 63% in 2023, 56% expected in 2024. So that is positive. I would be surprised if we don't, at a minimum, get a very high single-digit dividend increase by the end of this year. Free cash flow also very important for me. I want to see consistent increases over the longer term. They have more than doubled, and 2024 anticipated to go even higher. So again, lots of positive movements in terms of the expectations for full year 2024. No surprises with the sales growth. We did talk about a 3 to 7% baseline growth expectation. In fact, as we can see, 6 of the last 10 years negative growth, so very poor. Although the more recent year 10% is nice to note. Hopefully they can continue to increase those top lines. And whilst we do note they are looking at that $5 menu, given that is just a 1-month offering, hopefully they do have something up their sleeve so they can continue to bring the footfall back to the levels they have historically. In terms of total sales, this is what we looked at earlier, maybe just a different format to visualize. In terms of shares outstanding, returning excess cash to investor pockets, it is something that they do, not consistently, but always great to see, especially with a company that is offering nice dividend increases year on year. And the ROIC, return on invested capital, above 12% for restaurants. Remember, this does give us faith that management are able to effectively allocate their capital. Looking good over the longer term. Last 3 years looking very solid. Trailing 12 month as well, 25%. So we do like to see that. Does make this a lot more attractive for investors. And this is what I was talking about earlier. Yes, they are unable to increase their top line rapidly, but look at the margins. They are improving operational efficiency. I love to see that. 10 years ago, operating margin was 29%. Now it's at 46%. The same story to be told on the free cash flow margin, 15% in 2014, 29% in the more recent year. So lots of positives. Now imagine if they are able to increase their top line as well as those margins. That will be incredibly positive for this company. Now, net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, with below 3.5, what we want to see. And these are the number of years it would take the company to pay off all of their debt net of cash on hand. 3.13 in 2023. Now factor in that this does correlate to balance sheet strength, dividend safety. It is nice to note it is below that in 2023, expected to be there or thereabouts in 2024. It is a little bit too close. I would like to see it down into the high 2s at a minimum, so something just to keep in line, as if this does go very high, then that will impact those dividend increases at a bare minimum. But overall, it does look okay, no red flag indicators. And now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Multiple valuation model, then companies in a similar sector and size. Their P multiple, the average multiplied by the EPS of McDonald's, to get an intrinsic value now showing some nice undervaluation, 307 versus the market price of around 253. Now we then move on to the DDM model, the dividend discount. We have the yearly dividends, average growth 7.59%. We have gone a lot more conservative in our estimations, lower than the average as well as lower than the last 3 increases. That does give us an intrinsic value, again, undervaluation $314. We then move on to the DCF model. We have the free cash flow year on year, average growth near that 10% mark. Forward looking, we've gone between analyst targets of 10 to 12%. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to equity value, divide by the shares outstanding, and as we can see, another undervaluation signal. So the intrinsic value in today's episode is the average of these three models, and it does arrive at $302. Now do bear in mind you can grab a copy of this model to get to both intrinsic value and acceptable buy price of companies in your own portfolio, as well as those on your watch list. So margin of safety, as always, we do start off with 10%. Now we only execute on that if it meets the three criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that it is a buy up to $272, then we keep going till it's near the current trading price. Still a buy around 256 if you believe a 15% MOS level is warranted. At 20%, it isn't quite there yet at $241. So it really comes down to what margin of safety you believe to be sufficient as an investor, your investment thesis, and whether or not you are risk averse. So do let me know your thoughts in the comments below. But in today's episode, you are getting at least a 15% MOS level. In terms of Wall Street and their expectations, well, over the next 12 months, they do see the upside higher than our intrinsic value, $312, and they do see 23% as that implied upside over the next year. This is one that I also do hold in my own portfolio. It is one that I'm considering adding more if we do see it go higher towards that 20% MOS level, around the $245 mark. Right now though, you are getting a 15% MOS level. If you do believe that all of the bearish news that we talked about isn't going to affect this company over the longer term, then this could really be one to consider for the portfolio. As always though, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.